Hello again. We hope that you really enjoyed that session on responsible investment. It is a subject we take incredibly seriously at Ned Group Investments, and it's great to see that our best-of-breed manager, Taquanta, for all of our liquidity funds, shares that view and is fully aligned with us on responsible investment. We began the day talking about inflation. It's hugely topical. We had Ian Power from Truffle giving us his views. We're going to loop back to the inflation debate. We have been very fortunate that Fitch ratings have always supported this conference over the last 10 years. Unfortunately, they can't be here this year, but we do have Katie Falcone, who's a credit analyst for the Americas, coming to us via video from New York. This was pre-recorded, and she's going to give her perspectives and Fitch's perspectives on something that they have identified as potentially having a huge impact on many spheres, especially from their perspectives as rating agencies. So over to Katie.
My name is Katie Falcone. I'm a managing director with Fitch's Credit Policy Group, here to share our perspectives on the risk of U.S. inflation to credit ratings and what these risks could mean for markets more broadly. As noted in our recently launched series, Fitch Risk Headquarters, we maintain a short list of 5 to 6 key global macro risks at any given time that we believe could affect the greatest number of Fitch's ratings if they were to materialize. One of the risks on this list that we're keeping a close eye on is U.S. inflation, specifically for 2 reasons. One, of all the major developed economies, inflation pressures are strongest in the U.S., both for policy and structural supply and demand reasons. The Fed has explicitly said that it will prioritize a return to full employment and is perfectly happy to let inflation run above target for a period of time. Meanwhile, supply chain disruptions set against ongoing robust demand will continue to push consumer prices higher. The second reason is that our concern naturally becomes that although it is not our core expectation, in the event that policymakers were to lose credibility and U.S. inflation expectations became de-anchored amongst market participants, it could have a fairly rapid contagion effect into financial and real estate asset valuations. At a high level, Fitch sees a wind down of the Federal Reserve's asset purchases to be announced sometime in the next 12 months, which together with a strong U.S. recovery is boosting inflation expectations. We expect this to lift real interest rates from their unprecedented lows as the economic recovery gains traction, putting upward pressure on bond yields, even as the Fed keeps the Fed fund rates at its current range of 0 to 25 basis points until 2024. U.S. 10-year nominal bond yields have already risen and steepened significantly this year as the financial markets anticipate these trends. But real yields at between minus 0.5% and minus 1% over 2021 to date are more negative now than at any point after the financial crisis. Peacetime real yields in the U.S. have averaged 2% since 1900. Our economic team estimates that the U.S. fundamental equilibrium real interest rate is around 1%, implying a long-term nominal rate of 3%, which is quite a long way from where we are today. Fitch continues to evaluate the ways in which an inflation shock could feed through to ratings. And one example of this is that we've started looking at the investment portfolios of large banks and other financial institutions to estimate how big of a challenge some combination of higher volatility in rates, rising U.S. yields, and a potential sell-off in risky assets could be for these issuers, which could then easily translate into rising risk premia and higher borrowing costs on a broader basis, given the nature of their activities. At the corporate level, our analysts are much more concerned about inflation risk from the perspective of funding costs and market access than in terms of a potential profit margin squeeze. While maturity risk remains manageable, the leveraged loan market is a floating rate asset class, exposing issuers to rising rate risk if it takes hold. When we think about the connection points across Fitch's global key risks, a natural area of focus is the nexus between U.S. inflation and emerging markets. At the moment, the so-called reflation trade is keeping the trade-weighted U.S. dollar on a weakening trajectory, which is unusual at a time when U.S. growth prospects look so strong in the global context. From a debt perspective, Relative to the last downturn, emerging markets by and large have lower external financing needs, but rising local currency debt and higher participation by foreign investors in their local markets. We've already seen capital outflows pick up speed this year, so that's something to keep an eye on if an inflation scare provokes a shift away from the reflation trade and back toward risk-off sentiment. In the meantime, countries with deep local markets may be tempted to double down on QE measures, and those with access to non-resident capital may start to ramp up their foreign currency borrowing, either of which could raise future vulnerability profiles. Even absent these measures, we note that the aggregate increase in emerging market government debt to GDP in recent years has left these issuers significantly more sensitive to higher interest rates through higher debt service costs and debt sustainability challenges. Median emerging market general government debt increased to 62% of GDP at year-end 2020, up from just 34% at the end of 2012. In tandem, the median emerging market interest burden has roughly doubled over the past decade, in contrast to developed markets, which have benefited much more from low interest rates, as their interest payments are actually declining despite growing debt burdens. We will have to leave it there for today, but my colleagues and I welcome your feedback and questions. Thank you for joining.
Good morning, everyone, and thanks for joining us once again. Thanks to Katie from Fitch for presenting that with us. Just looking at tomorrow's agenda, we're very excited to be joined by Nedbank CIB tomorrow. The agenda as follows. We'll be starting with Nikki Weimer in the morning, our resident Nedbank economist. I think it's Nikki's 9th year she'll be doing this conference, so thanks very much to Nikki. We then followed from Richard and Rizwan from CIB on the sell side of the business. And then we are closing with Jones Gondo, who's looking at the SOEs in our business and how we can track or build or invest with them in the future. So that's tomorrow's agenda, which we're very excited about. Also, yesterday I mentioned that we are hosting our Charity Day, which will be on the 29th of October, 2021. And just a bit of insight to that, so we will launch some more details later. But effectively what that means that every client that invests with us on that day, and it doesn't matter what you invest with us on that day, all the fees we earn from that day, we will be paying over to charities of our choice. And we've obviously gone through a process where we've identified these charities and we will obviously fund them accordingly. There's going to be a short video on that charity, and after that video, the QR code will pop up again. Once again, you just take your phone out, open up your camera, and you'll be able to do that feedback session for us. We really appreciate it. If you can give us any ideas how we can improve, it would be great. But thanks for joining us today. We look forward to seeing you tomorrow.